bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 3rd, 2026 episode. And we're actually recording this on February 3rd, 2026. Oftentimes we record a few days before, but I am in Colorado. I'll be keynoting the CHAFA biannual conference on long-term tax credits and all things affordable rental housing. So we're recording from my hotel room. As our audience can see, my guest this week is my partner, Dirk Wallace. He's in Novogradac's Dover, Ohio office. And Dirk is one of Novogradac's leading long-term housing tax credit experts, and more broadly, all things affordable rental housing related. And he does lead the Novogradac Long-Term Housing Tax Credit Working Group. Now, Dirk's clients range from developers and lenders to syndicators and direct investors. And as such, he brings a wealth of knowledge to today's discussion. Our topic today is how lowering of the 50% test down to 25% is affecting project financing. Now, the test was lowered from 50% to 25% last year as part of the One Big Beautiful Bill Act. And that change took effect on January 1st. Now, the beauty of this change is that the same amount of bond financing can now theoretically finance twice the properties previously financed. Now, I say theoretically because when a developer receives a lower amount of tax and bond financing, they will have a greater financing gap. And you may be wondering why that is. Dirk will discuss that in more detail. I also say theoretically because the vast majority of new construction private activity bond finance tax credit properties have some amount of soft financing to be financially viable. And the availability of that soft financing doesn't scale on a one-to-one basis with the lowering of the 50% test. With that said, Dirk and I today are going to discuss ways in which developers can close financing gaps generated by the fact that the private activity bond amount has been reduced. We'll also discuss the availability of traditional soft financing sources that don't scale with the increased number of developments financed. Dirk and I are eager to talk about this topic, as I'm sure you are. So with that in mind, I want to dive right in. We have a lot to discuss. So if you're ready, let's get started. Dirk, welcome back to Tax Credit Tuesday.
Thanks, Mike. Great to be back.
So I don't know if you're counting, but this is your 17th appearance on Tax Credit Tuesday. As you may recall, your last appearance was in October. And there you were part of our annual equity market discussion with our partners, Tony Grapponi and Brad Elphick. You were covering all things housing, Tony, renewable energy, and Brad, new markets and historics. So we'll get you back in a few months to give your update on the equity markets, but that's not today's discussion. But before we get into today's discussion on ways to close financing gaps when the 50% test is lowered, please describe some of the many services you provide to Novogradac clients.
Sure. So I provide to developers, syndicators, investors, obviously audit and tax services as an accountant, as well as cost certifications, financial forecasts, and also preparing a lot of the tests that we're going to talk about today related to taxes and bond transactions.
Great. So thank you for that, Dirk. Please start off this podcast by giving our audience an overview of what the 25% test is and how we got here.
Sure. So prior to 2026, LIHTC developments that wanted to receive their full 4% LIHTC allocation had to have at least 50% of their land and building or land and depreciable basis financed by taxes and bonds. So if 50% of that was financed by taxes and bonds, they received their credits. And we commonly refer to that as the 50% test. In many states, properties wouldn't just be allocated exactly 50%. They'd be allocated 52, 55, maybe even up to 60% taxes and bonds. And that would ensure that they can meet that test and get all of the 4% tax credits. This was creating a situation where developers were going after construction financing that maybe they didn't necessarily need the full amount. Maybe they needed 40% or 45%, but they were getting more construction financing than they needed just to meet this test. So the One Big Beautiful Bill Act lowered this test from 50% to 25% to try to help with that problem. And so developers weren't getting more financing than they actually needed just to claim the tax credits. So for bonds issued after December 31st of 25 and for properties placed in service after the same date, you now qualify for the 25% test rather than the 50% test. And since we're in 2026, the 25% test is in full force and is applicable nationwide.
So great. Thank you for that. Now, I mentioned in the intro that if a developer was used to getting, say, a 55% of the land and building costs financed by productivity bonds, and assume for the moment that those bonds were going to be outstanding for the full term, so they could use all of that, their property could support, their net operating income could support that level of productivity bond financing. Now they go in and apply in the state saying, well, we're going to limit you to 27.5% or 30% because we want to do 100% more developments, 100% more units financed with productivity bonds. We got to cut everyone in half. That the sheer fact of doing that will create a financing gap for a given development if you assume it was at a balanced set of financing before this reduction. Please explain to the audience why that is from a financing perspective. And if you have a sense as to how much of an additional financing gap that creates, that would be good to share as well.
Sure. This is commonly referred to as the taxable tail financing structure. So the tax exempt financing, as you mentioned, that could be limited in the states to 30 or 40%. That gap that is there has to be financed by some type of debt. And if tax exempt financing isn't available, taxable financing is typically the first place a developer would go. So that taxable financing is just a small amount of the primary financing, but it does come with a higher interest rate. In today's environment, the spread between tax exempt and taxable could be 75 basis points. If you're looking at debt with a higher interest rate, obviously the project cannot support the same amount as they could at a lower interest rate. So this creates a gap in a lot of projects because of that higher interest rate. There is additional cost of issuance, and you're looking at a financing gap on the low end, maybe around 2 or 3%. That financing gap can go up to 5, 6% by having taxable financing instead of tax exempt financing.
Great. Thank you for that explanation. The whole purpose of using the productivity bonds to finance residential rental housing, as we're discussing it here, is so it does bring long-term tax credits to the property. There's also this concept of recycled productivity bonds. And if you use a recycled bond, recycled productivity bonds, that does not bring tax credits to the development, but it does bring that beneficial financing rate. So if you could describe for our audience this concept of recycled bonds, and that could be a tool to replace the taxable tail, in essence, to have a recycled bond tax exempt tail.
That's correct. Recycled bonds is a concept where you have a short-term bond, and that short-term bond is repaid. And if it's repaid within 4 years, you have the ability to recycle that bond into another project at the tax exempt rate. Now, there's a lot of windows you have to look at. A lot of people say it's a 3-year window because really those bonds do have to be redeployed within 4 years of the original issuance, but you only have 6 months from when they're paid to reissue them. So a lot of projects look and say, okay, well, after 3 years and a few months, if they're repaid, now that 6-month clock starts ticking and the bonds can be recycled then within that 6 months to another project. As you mentioned, they will not qualify for the 25% test, so they don't generate tax credits, but they do help fill that gap with the tax exempt rate, as well as they still have to meet the other tests like the 95.5 test for bonds. And they are tax exempt bonds. They look like tax exempt bonds. They just don't generate tax credits.
Now, when we were preparing for this podcast, we also talked about how the fact that you mentioned this 3 to 4 year window and then the 6-month period, and it does appear to be out in many states a large amount of recycled bonds, these bonds available for recycling. And that's in part because what you mentioned, if a project back in the day was getting a 55% of the land and building costs in productivity bonds, but could only support, say, 40% or 30%, that portion of the productivity bonds would by definition be paid off early, and that
Mhm.
ends up creating a capacity of recycling.
Right.
And you were pointing out that one of the steps that many developers are using now for financing productivity bond finance developments is only to keep those bonds outstanding for a couple of years and then use HUD insured loan because they can have a lower rate. So if you could discuss that HUD insured loan product and what you're seeing out in the marketplace, I think many of our audience may not be thinking about that. And that could be something that they want to incorporate into their financing toolbox.
Sure. So really the financing structure during construction is very similar to the cashback collateralized structure. You have your bonds outstanding, short-term bonds, you have a HUD insured loan where you have a higher short-term interest rate during construction on that short-term loan. And what you are able to do is you can essentially use a higher rate during construction to decrease or create discount points for your long-term rate during the permanent loan period. So at the end of construction, the HUD insured, say 221B4 loan would be used to pay off the bonds. The 221B4 loan would then remain outstanding as your permanent loan. And based on interest rates, this could be an interest rate that is lower than your tax exempt rate, which would be one reason why you would do that, to have that perm loan outstanding. That's more beneficial than having a long-term tax exempt rate.
And then those loans also can have a longer amortization period.
That's correct. Yeah, you can have 30 or up to 40-year amortization period with those types of loans.
And I mentioned a longer amortization period in part because while the interest rate advantage may not be quite as great, if you're amortizing the principal balance down for a longer period of time, the same amount of NOI can support more debt. So it does seem like every developer should be reviewing that structure to see if that enhances the viability of the project financing for a given transaction. It's also interesting because more of those transactions, that should create more recycled bond capacity because then the bonds aren't staying out as long.
That's correct. And for anyone worried about the HUD timeline to close on a HUD insured loan, I know there is a streamlined HUD timeline for LIHTC properties. Word from HUD is there may be a hyper accelerated timeline coming soon. We will see what that looks like, but HUD is aware of timing considerations when using their products.
Well, thank you for showing that. I'm sure there's a large portion of our audience that wasn't aware of that, or at least it wasn't front of mind for them. And at a minimum, it'll need them to be looking at that. And hopefully that comment itself will finance a few more affordable housing developments. So thank you for that. Continuing the discussion of filling the financing gap, one of the ways that many states have been using productivity bonds to finance new construction is through the enactment or expansion of state tax credits. California, for instance, created a $500 million pool of state tax credits to help fill the financing gap. How are state tax credits helping fill financing gaps with the lowering of the 50% test?
Great. And this was on the front of my mind because I just got done updating our own housing tax credit handbook on the state tax credit section. I was going through the list of all the states out there that have state tax credits, and that list is expanding every single day. There are states like Georgia where the state tax credit is uncapped. So the expansion of 4% projects because of lowering the 25% test is really taking off in Georgia because all projects that apply for 4% credits can get the state credit as well in Georgia. Most states do have a cap. I think Georgia would be the outlier. But again, Ohio, my home state, has a cap that they have a state credit. You mentioned California. State credits are really becoming more flexible too, because states are aware that certain state structures work better than others. So you might hear things like certificated credits or allocated credits, things like that. States are really recognizing that they want to maximize what a state credit is worth as well. And we're working with states for them to become flexible to really increase those proceeds and fill those gaps.
That's an excellent point about states being flexible to get the highest equity value for their state tax credits. So let's turn to federal debt resources. There's a number of soft federal debt sources. And when I think of that, I think of home funds. I think of block grant funding. I think of capital magnet funds. I think of housing trust funds. Please share with the audience what you're seeing with respect to these softer federal debt resources?
Yeah, a lot of the federal resources that you mentioned, where we're seeing in properties. Another one would be the housing trust funds. For developers that are looking at housing trust funds or even capital magnet funds, really look at how those are structured. There's loans and there's grants. So make sure that the funds are coming into your property in the most advantageous way for you. Because we have seen some, call them foot faults, on people checking the wrong box, and all of a sudden they have a taxable grant coming into their property that no one had really seen coming. So I think the ones you mentioned, along with housing trust funds, are at the federal level, are really the main financing gap fillers that we're seeing.
And I'd also encourage developers and nonprofits to consider applying for capital magnet funds. And yes, Novogradac can help you. So please reach out if you're interested in learning more about that. So turning to the state level in terms of resources, both grants and soft debt, and actually let's just think of the state and the local governments. How are you seeing state legislatures and local governments responding in terms of trying to create scalable sources of soft financing? I wrote an article for the Washington Wire in the Journal of Tax Credits a few months back talking about different types of financing that's scalable and not scalable. And I know that one of the ways in which in California and a lot of states there's some sort of state property tax abatement. And as a general matter, that tends to be scalable in the sense that it's not capped. A lot of people don't think of that as soft financing, but it is soft financing because they'll let you raise more hard debt, if you will. So that's a way, that is one of the resources that are scalable. But what are you seeing at the state legislature and local government responding?
Yeah, in addition to the state LIHTC that we had mentioned, a lot of states do have programs, whether it's gap financing programs or programs that help subsidize permanent financing, which can increase the per loan amount. My home state of Ohio has a bond gap financing program in and of itself. That is typically oversubscribed, so that's not necessarily scalable, but Tennessee has what they call a CITC program, and that is a tax credit that banks claim for offering a lower interest rate on affordable housing properties. So they loan at prime minus 4%, which a few years ago was zero. Now prime is obviously much higher than 4%, but still that program is very powerful in helping increase perm debt. It can also be used to finance construction as well. So those are two examples that I'm seeing, and there's many other states that have soft loan programs. State housing trust funds, which are different than federal housing trust funds. State housing trust funds, the states have their own program as well.
So let's turn to the role of state housing allocating agencies, or just allocating agencies, since they're not always state allocating agencies, not universally state. Some of the steps that state allocating agents or credit allocating agencies can take to help close the financing gap that this is creating. And we know that on the cost side, there's across the country, I think there's a real focus on trying to lower the cost of affordable housing. So certainly the backdoor way of closing financing gaps is to lower the cost of building. And there can be requirements in a quality allocation plan and a competition that drive up costs. So certainly that's one step that states can take. But when we were preparing for the podcast, you mentioned, states looking at larger developer fees for private utility bond transactions. Please explain that and how that helps with the financing.
Right. So there are a number of states that already have policies in place, and we're hearing that the ones that don't have policies are looking at implementing something similar, where the developer fee limits for 9% transactions are lower than for 4% transactions. 4% transactions are getting higher rates. In some states, I've seen 15% for 9, 17% for 4. In Tennessee, it's up to 25% for a 4% transaction. Now, just remember that the fee still needs to be reasonable, still needs to be repaid, and that the services provided are still justifying the fee. So the concept for when most attorneys are writing the developer fee agreements are for tax and bond transaction, multiple layers of financing, additional services generates higher fees. So the attorneys are able to structure that developer fee agreement to justify that higher fee. But in other states like Maryland, while the state does allow an increased fee, they have the developer loan that increase back to the project. So if it's a 15% fee and you get a 2% increase up to 17, that 2% is then loaned back to the property. And for nonprofit developers, you may recognize some income and loan it back. But for-profit developers, just watch how that interplay is with income and loaning back to the property, because you don't want to get hit with the tax bill that you weren't expecting when it comes tax time.
Now, I don't know if the next idea is the most exotic, but it's got to be in competition for the most exotic if it isn't, that a state housing agency can take. And that is taking an existing multi-building or even single building that's condoed and separating it into two distinct projects, one being a 9% and one being a 4%. And you've heard me speak before, Dirk, about the fact that if states take their 4% and 9% and combine them together, they'll get fewer 9% units, but they'll get a lot more 4% units. And the concept is that the 9% can be covering a greater amount of costs on a per unit basis. And as a consequence, the 4% doesn't have to cover as much, which is maybe not a very artful way of saying, in essence, the 9% is serving as a bit of soft financing for the 4%, albeit done. There's two separate projects in the rest, but there's a way of combining those two. And that's something that was starting to become more in vogue a few years ago. And there are a number of structural issues in the rest that cause that to be less in vogue. What are you seeing on that front these days?
We are seeing that make its way into some state QAPs. So if you're going for a 9% award, maybe look and see if you would get additional points for that 9% award if you would do a 9 and a 4 transaction. Again, the timing also has to work out, especially if it's one physical structure with two condos. You can't just build half of a building at once. You'd have to build the whole thing. And in places where it works, sometimes there may be higher rents, so the 4% can still support the debt service that it needs to make the 4 and the 9 work. But there's really no one size fits all in the 4 and the 9. I think every state is really different, where you're just really looking at what is that sweet spot. How many 9% units do I need versus how many 4? Because the 9% will likely pencil out. It's the 4% that you need to find that sweet spot for what makes the whole project work out.
And I like what you said there at the end about the 9% offense law. And that's really what is driving this, is the 9%, because you can give a 30% bonus even if you're not in a difficult to develop area. 9%, you can always give a project enough credits in nearly all circumstances to be financially viable. So generally speaking, you're not getting as much in credits as you theoretically could claim because it's not needed for financial feasibility. Whereas that's the complete opposite, 4%. So let's turn to, as we expand, and there's so many ways in which we can address this closing of the financing gap. Obviously, we can't cover all the various areas and the various little tweaks. And that's one thing that I know developers, it's basically, you've got this financial forecast, you have a sources and a uses side. And one way to raise the sources side on the hard financing side is to have more net operating income. And from a net operating income perspective, obviously you're rent restricted, income restricted. As a consequence, the income side generally is less variable. There is average income tests and things like that. So those developers out there can say, yes, that's not quite true, Mike. But as a general matter, those you can look at and what tenant population you're trying to serve in the rest. But talk about on the operating expense side, what you're seeing out there in terms of creative ways to lower your operating expenses, such that you have slightly more NOI. And obviously for every additional amount of NOI, that lets you leverage that much more in debt financing.
Yeah, so the main operating expenses are the big ticket items, obviously being taxes and insurance and the utilities in a property. We mentioned local tax abatements, that of being scalable, and talking to your local tax authority about that. Developers with a larger portfolio that might be able to try to limit the insurance exposure could do a group policy, especially if the properties are in the same area. But even if they're scattered, I've heard instances of there being savings due to a group policy. One thing I've been hearing more and more about on the utility front is companies looking at water savings. Apparently water cost is a big expense in properties. And I hear water pressure is not affected, so you still can have good water pressure, but the water usage, there's ways in the systems that they put in place and the types of appliances and things like that they put in can really limit the water usage and create substantial savings, which increases your permanent debt. And then the last one just being looking at energy tax credits, looking at geothermal or solar. There's no longer a basis reduction for LIHTC for those energy credits. If you can save on the operating expense side and still be able to pay for the solar installation of the geothermal unit, that can save on the permanent financing as well.
So maybe I'll get towards the close here, but move outside of ways to close the financing gap for the lowering of the 50% test. That sort of helps create, as well as the fact that there's a greater capacity to fund more transactions, which in and of itself creates financing gaps for those additional transactions, if you will. There's been a lot of focus on new construction by so many allocating agencies, and justifiably so, in terms of trying to increase the supply, which creates not just the benefits for the tenants in that new supply, but also for ancillary tenants. There's an impact on rent levels and the like. And as a consequence of that, there has been a slow decline in the amount of AC rehab transactions that have been getting financing. And maybe share with the audience here some of the need that's out there, the historical need and the deferred maintenance, to the extent that there's not enough soft financing to focus productivity bonds on new construction. There's an opportunity for renovating existing properties.
Sure. Well, the home causing tax credit program has been around for 40 years, and a lot of the properties are coming to the end of not only their 15-year compliance period, but the 30-year compliance period.
Yes.
So there's obviously a great need for rehab there. A few things to look at when you're looking at AC rehab properties. One, the seller note can be powerful. The seller take back note is a financing source where you're getting credits on the appraised value of the acquisition, taking back a seller note, and then using that to generate credits to fill that gap. The other thing is a lot of public housing authorities have housing stock that, if they're partnering with a for-profit developer, maybe that for-profit developer can help them through a RAD transaction. Rich Larson, part of Novogradac, our Toms River office, does a lot of RAD consulting, RAD transactions. We're seeing them a lot in LIHTC transactions now. So if you're a for-profit developer, reach out to your local housing authority and see if they have any housing stock and see if they might have an appetite for a RAD transaction.
Great. That's excellent. And I always want to talk about AC rehab whenever I'm speaking about the lowering of the 50% test, because I do feel so many areas and so many developers, along with so many allocated agencies, have been so focused on increasing supply that they're not as aware of, yes, this is in front of mind. And as you pointed out, an AC rehab transaction isn't nearly as dependent on soft financing as new construction is to be financially viable. I also want to just toss out there, and I'm curious what the audience thinks, and feel free to share your thoughts by sending an email to contact@novoco.com. This could be a good time, particularly in some of the markets that the market rents has been sliding. This could be a great opportunity for productivity bonds to be used to acquire existing market rate, in the sense that it has no restrictions in place, and do a renovation, make it available, upgrade the property, end up putting rent and income restrictions on the property. And then when those rents start rising in that market in the next year or two, you basically locked in a lot of affordable housing at a relatively economical rate. And I suspect 5 years from now, if I have you back, we'll be talking about some allocated agencies that saw the benefits of that and really help develop and expand their affordable housing stock. Thank you, Dirk. I appreciate you joining me on the podcast. We shared a number of resources in this podcast that are techniques to help close financing gaps. I do want to encourage our listeners, though, because we did not have an exhaustive list by any stretch. If you are a member of our audience and you have additional options that you think are really successful and we should be sharing with others, please email them to us at contact@novoco.com. I will give a shout out on an upcoming podcast to the member or members of the audience who share particularly unique, clever, or not widely used techniques, because we love to be fostering the development of and financing of more affordable housing through productivity bonds. I will include Dirk's contact information in today's show notes. And then Dirk, before we get to the close, what other resources do you recommend for our audience to learn more?
Sure. The Low Income Housing Tax Credit Working Group here at Novogradac is a great organization to join. You can email myself about how to join that group. I'll be speaking in our San Diego conference in May 7th and May 8th in beautiful San Diego. Please join us there. I'll be discussing a hot topics panel, which I'm sure will include implementing the 25% test and additional things that we're seeing within the industry. And as always, feel free to reach out for any of the services that I mentioned before, as well as if you're looking at an application for the first time, we can certainly help walk you through that process.
Thank you, Dirk. I'll be in San Diego as well. I always like to share with members of the audience that if you are going to attend, please take a moment and come up and say hello to Dirk and say hello to me. I'll be doing the Thursday morning Washington Wire to share the latest on what's happening in Washington, D.C. and across the nation with respect to affordable housing with a focus on the low income tax credit. Dirk, please stick around for our off-mic section. But before we go there, if you're a member of our audience and like what we're doing here at Tax Credit Tuesday, please subscribe to the podcast. Also, please take a moment to like and comment on the episode. That helps raise our visibility and encourages us to keep producing Tax Credit Tuesday. And please do share with your colleagues episodes of Tax Credit Tuesday that you find would be particularly useful for them in terms of growing and expanding their knowledge of all things affordable rental housing. Now we've reached our off-mic section, and we like to use this space to give a shout out to others working in the tax credit and tax incentive communities. We get to highlight a professional worthy of recognition. And if there's one thing there's not enough of in this world, it's positive recognition and reinforcement. Dirk, who would you like to shout out?
I would like to shout out Stockton Williams at NCSHA and really all the staff at NCSHA that have been helping get the information out about the 25% test and the state policies. They've created a map on their website that has all the state's 25% test policies out there, which is a good resource for folks to look at.
So I echo your shout as well to Stockton Williams and others at NCSHA. To a certain extent, I see Stockton Williams as the Wayne Gretzky of tax credit housing. And you might be saying, why am I saying that? People know how talented Stockton is and how knowledgeable he is. And I love his weekly email that comes out every Friday discussing things that are happening in the affordable housing space. But when I think of Wayne Gretzky, I think of his comments about skating to where the puck is going, not where it is. And to Stockton and NCSHA's credit, before the One Big Beautiful Act was passed, they were planning their July workshop for executive directors of state housing agencies at the end of July. And one of the topics was how states, the most effective ways, or some of the ways in which states can implement the lowering of the 50% test. I appreciated being invited to speak there, but he saw where the puck was going. And by having that meeting at the end of July, so many state housing agencies were able to get an accelerated assessment of how they're going to implement it. And many states were able to make some changes back in 2025 that basically allowed them to leverage some of their 2025 bond volume authority and use it as effectively a 25% test instead of a 50% test, which led to more housing being created that wouldn't have otherwise been available. So kudos to Stockton Williams on that, and kudos to all the state housing agencies that embraced and made changes so quickly last year in order to make more affordable housing available to more Americans across the country. And with that, thank you, Dirk, for being on the podcast today.
No problem. Thanks for having me.
And to our audience, Michael Novogradac, thanks for joining us.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.